in the tech sector, it's quite interesting that some companies are doing very, very well, i.e. Zoom or i.e. work from home type companies, Slack, this type of tech company, and other companies are doing terrible, like OTA, online travel agents, people dealing with hotels, Airbnb, these kind of companies are suffering dramatically from the lockdowns and from the lack of mobility among people and things like that.
The biggest issue is we need to figure out which markets are going to rebound and how, but we also need to figure out the markets that are going through the roof right now. For example, gaming, collaboration, anything related to remote working, which is going through the roof right now. We also need to figure out if those markets are at peak level right now and they will sustain that level afterwards or not.
Well, I think COVID is a very good opportunity for quality investments. It's a very good opportunity for fundraising, for vintages, and a fantastic opportunity to really test your captains of your ships, how well they can steer those boats.
Okay, so I'm Dina Mostovaya. I'm a PR consultant and the founder of Mindset Consultant. So I do PR and communications for startups and venture funds. And here I am with my colleague Anastasia Karpova. So she's from Forbes Russia, and we will ask some questions. So let's start. Who wants to be the first?
I'm happy to go first as an intro, I guess. Hi, everyone. My name is Nuno Goncalves Pedro. I'm a managing partner and founder at Strive Capital. I'm based in the San Francisco Bay Area. I'm also a venture partner with Christian Robotics. So I actually work with two venture capital firms. Strive Capital, we focus on consumer software and software as a service. We've made investments in companies like App Annie, Gusto, Rubrik, DraftKings, OmConnect, Verta Health, and a few others. Our claim to fame is we were probably the first early stage quant fund, so driving a significant part of our deal flow from an analytics engine that we built in-house and also helping us with due diligence. And as I mentioned, I'm also a venture partner with Christian Robotics, which is a Sand Hill Road venture capital firm focused on Series A and Series B investments, mostly around physical tech, but more recently around consumer.
Great. Okay. So yes, should we just introduce yourself, like everybody right now, and then we should ask some questions. Alexey, what do you want to introduce yourself?
We can't hear you, Alexey.
Yes. Could you please
turn on your mic?
Yeah.
Thank you.
Yeah. Thank you. I'm Alexey Alexanov, and I'm a co-founder and general partner at Cabra VC. We invest in US-based subscription-driven companies, mostly which affect onboarding and engagement. It's all about customer engagement technology. And we also do investment in India.
Great.
Thank you.
Thanks a lot.
Yeah, welcome.
Tom, do you want to tell about yourself?
We can't
hear you.
Indeed, was on mute as well. Sorry. Yes, I'm Tom Henriksson. Hello, general partner at OpenOcean. We are B2B software, enterprise software experts, investing in European early stage, typically A-round B2B software companies. We built 3 such companies ourselves in the past to scale and global leadership, and now we've been investing from 3 institutional funds into similar stories.
Great, thank you. Hi, Omiros. Do you want to join us?
Hi there. Can you hear?
Yeah.
Yeah. Can you hear me?
Yes.
We can.
Hello from London. So we are a fund based in London that, peculiarly enough, invests in South and Eastern Europe, particularly in Greece, my home country in Greece. We invest in asymmetry and asymmetric markets. So we find regions that are experiencing a U-turn, and we focus to invest in the right time, just before the upward stream. We are one of the few funds in the country that are very flexible. So we do growth series capital. Somebody's phone, that's not mine.
Yeah, sorry.
I don't know whose that is.
It was me, sorry.
Okay, Dina, which reminds me to close my phone too. So we have, we're doing growth capital in Greece. Greece has an ecosystem of venture capital, which is funded by the European Investment Fund. And then it has large funds, which are by ex-CEOs of the big banks. There was a huge gap in the middle, which we captured. And we're funded by entrepreneurial capital, effectively some of the oligarchs of Greece, some of the industrialists or professionals. We have all been working in London or abroad for a couple of decades, pretty much all my adult life, and we have invested back in the country. The claim to fame, as Nuno called it, is that we made about 57 times our money in Greece so far, which is not a bad record. So we're quite happy with the performance, and we brought effectively quite a few of our friends in the process, which now we have a platform which combines the best of England and the best of Greece. So we're doing investments in the what you will call late stage VC, early stage P. We call it growth cap or debt cap. So that is us.
Thank you so much.
Okay.
I think it's safe to assume if that was in a Zoom, it would have been much better. That platform seems to be very difficult to join. I think if we have all done it all in Zoom, it would have been broadcasted much easier. But for whatever reason, I think it's limiting the amount of guests and it's limiting the amount of the presenters who have bandwidth. I mean, I'm dialing in from a 400 megabps line, so super duper fast, and I still can see the flickering from the other side coming in. It's very hard.
Okay, great. So I'm in touch with Yelena. So she said that Chris is here as well, but we can't see him. Chris.
Hi, Dina. How are you?
Yes. How are you? Yeah, good.
Hi,
Where are you now?
I'm sorry. I'm in Hong Kong.
Sure.
Apologies.
Oh, wow.
I can't turn on my video. I was playing around with it, but I think the voice is working. So.
Good.
Shall I do a quick intro?
Yeah. Sure. Yeah.
Great. So I'm Chris Fisher. I am based in Hong Kong with a venture firm called Click Ventures. We're a Series A focused global VC fund that focuses on companies that generate some kind of network effect. We're invested in companies such as Event Extra, Memebox, Spotify, Mogul, Palantir, Crave, Link, Equity Zen, you might have heard of, and a few others around Asia and in Hong Kong. I am an operating partner with them. I work with the portfolio companies. Originally, I was a partner for Fund 3. For Fund 4, I'm stepping back to operating partner, and I'm also starting a new hat, working for a later stage fund called GPO Fund, based in New York, which invests in later stage SaaS companies, typically SaaS and some other SaaS-like revenue companies at around a Series B or a Series C round.
Thank you.
Okay, great. Okay, so we should start with the questions, I guess.
I think we have some topics to discuss, and the first is rethinking portfolio companies' go-to-market strategies. What has changed and what not?
Shall one of us address it? I guess, yeah. I actually run a podcast with Bertrand Schmidt, who was the co-founder and now chairman at App Annie, and we just had an episode on COVID, actually a two-part episode on COVID, and we discussed it quite heavily. But let me address it. I mean, the thing that's changed most obviously is most of us are at home, right? And it's not just startups are at home; venture capitalists and investors are at home as well. So the first element of that has changed in the market right now, in particular if you're fundraising, is there's a little bit of a latency or a lag in how investors are dealing with stuff, because shockingly enough, we're human beings, and some of us have kids, and some of us have families, and we have to take care of logistics, and so there's immediately one step of lag and latency in there. The second step of lag and latency depends on your fund. I mean, if the fund is basically linked to limited partners, our own investors, so venture capital investors are called limited partners. They basically, it depends on whether these limited partners are, limited partners that have cash liquidity. And so if you do so-called capital calls or cash calls as a venture capital firm to invest in a company, if they actually give you the cash actually matters as well. So if you get the cash, let's assume your limited partners are doing well and they have the cash to give you and everything is good, then everything's awesome. But if that's not the case, then you actually don't have the cash to give to companies either way. Assuming you do have the cash, the third element that's happening is certainly, and here I'm talking more of a Silicon Valley, Bay Area element, although we do invest across the world. The world has really changed towards being very, very entrepreneur friendly. The terms and conditions of deals here in the Bay Area have changed to become very entrepreneur friendly. And now there's a rebalancing. And I think that rebalancing actually didn't start with COVID. It started with SoftBank and what happened late last year with obviously a little bit what we saw as an implosion of SoftBank as an investor. And what we're seeing right now is obviously valuations are coming down. They've come down in late stage, they've come down in middle stage, and they are also coming down in early stage dramatically, 20 to 50% certainly in the Bay Area. And it's become more difficult for some of these startups to raise money. And what that means, if you're a venture capital on the other side of the fence, is you can cherry pick. You can become a little bit more aggressive and have a higher bar for the investments you're making. Now, that all said, investors that have capital to deploy are still deploying capital, and this is a great time to be in the market. I certainly think, from the perspective of Grisham Robotics and also Strive Capital, that the fact that both of us are deploying capital right now is actually awesome because, everyone says the basic thing, which is, at this moment in time, we've had a lot of companies created in or around crisis, which is actually factually correct. But I do think there's a lot of amazing companies in the market right now, and companies that can withstand the crisis that we're in will come out of it even stronger. So definitely a great time to be investing.
Thank you.
Yeah,
Yes.
I agree with that. What I've been seeing, especially as it reflects in go-to-market strategies. So as a fund manager, well, first of all, there was a lot of capital raised over the last year, 2 years. It's been unprecedented highs, I think, in most areas of the world. So there is a lot of dry powder out there. There's actually quite a bit of capital sitting out there that's available to be put into companies. But right now, I think, especially the last 2 or 3 months, VCs have been extremely busy, really working with their portfolio companies more actively than perhaps they do in more normal times. A lot of companies are being challenged. In the tech sector, it's quite interesting that some companies are doing very, very well, i.e. Zoom or i.e. work from home type companies, Slack, this type of tech company, and other companies are doing terrible, like OTA, online travel agents, people dealing with hotels, Airbnb, these kind of companies are suffering dramatically from the lockdowns and from the lack of mobility among people and things like that. So, as is the case in most of these kind of downturns in 08 and 01, VCs kind of have to step back and take a look and assess the situation, as do founders. Founders need to take a look at their businesses, see how they could potentially be affected, make sure that they have enough runway, enough cash to survive for the foreseeable future. If they don't have enough cash on their balance sheet, it's actually probably a little too late by the time we're having this conference right now. But in January, February, you should have been looking, to put some cash on the balance sheet if you in any way can, and start to hunker down for what could potentially be a protracted downturn, or even if it's a V-shaped recovery, there's still quite a bit of risk ahead. So in terms of go-to-market strategies, I think, being conservative on cash, figuring out where you can cut costs, assessing your customers to make sure that they're potentially going to be able to pay you. Look at your, any kind of receivables you might have. Look at any kind of contracts coming up for renewal. Be proactive, reach out to those customers, and spend a lot of time,
making sure that you don't end up with a bunch of churn, that you can basically keep your retention high. I find that works pretty well when you're proactive about it and don't let problems kind of slip under the rug, where maybe a customer is on the verge of insolvency. Maybe you reach out to them with the payment plan. Maybe you try to help them to make their commitments and stuff like that. So I guess what I'm basically saying is to shift into kind of preservation mode, and we're seeing a lot of our portfolio companies are focusing a little bit less on growth and a little bit less on major expansion, and really trying to batten down the hatches, so to speak.
So,
Great, Tom, do you want? Yes, thank you.
Yes. So because I think the question was actually mainly on go-to-market strategies here, right? So I want to dive in a little bit further into that. I will speak mainly from the perspective of a software business, because that's what I do and what I know. And there was already a mention about the industry. Depending on what industry you're in, you're affected in different ways, and I'll table that for a second. But so that is obviously one very large factor. The other one, how you're affected, is very much in what is your go-to-market model, your business model, your revenue model. Because if you're one of those, and now again, software businesses that actually needs to knock on doors and ask if anybody's interested in buying what you have, and have face-to-face meetings, many of them perhaps to actually get somebody to say, yes, I want it, and then even have to do integrations, maybe on site at the customers, before you actually get the solution delivered to the customer. Obviously, in that scenario, you're kind of screwed right now, because that has completely changed and been taken out as a model. And even if you have some lighter elements in that mix, but if it's still a, let's call it, fairly heavy go-to-market model with fairly long sales cycles with some integrations, you will be severely affected. I mean, we see in the companies that such businesses, I mean, they experience 2 to 3 times longer lead cycles. The customers don't buy much, because if their ACVs are high, they just don't have the budget, and so on. So that's one, place you don't want to be in. Obviously, if you're on the completely different side of the spectrum and you sell, let's call it, fairly light software that is sold online, delivered online, marketing driven as a sales model, and you don't need that much human involvement. Maybe you're even so lucky that it sells itself, it goes viral, and it's totally self-serve. Some companies have that, not many. Usually you need to be a little bit involved. But if you're more on that side, you might not experience much of a change at the moment, especially if your solution is not very expensive. If you get into the bigger ACVs, where there are more stakeholders to actually get the decision done, and big budgets in general will be harder to come by at the moment, then even in that model, you probably will be experiencing slowness, inertia. But if you sell something that's fairly inexpensive and is really needed, regardless of coronas and other crises, then you might actually do quite well. And now I'll come back, finishing it off with the industry. Then obviously, on top of that, depending on if you sell something that actually is needed more now, you might even benefit, right? But even if you have a good model, and if you're selling something that is maybe not that essential, you will feel it. And I'm happy to get into much more detail on this, because this is my passion. But I'll let others speak for a while.
Thank you. Tess is joining us. Hi, Tess. How are
Welcome,
you?
Tess.
Hi.
I'm great.
Can you tell
Thanks.
about yourself? Because we just started to tell about our companies and about the industry.
Yes, excellent. Thank you. So nice meeting everyone. I'm Tess Howe, a founder of Tess Venture. I myself and actually my team have been investing in early stage startups, mainly now the last 10 years in Silicon Valley. Prior to that, more of a global focus. However, even though we're based out of Silicon Valley, we actually invest in emerging markets. We invest, early stage, essentially now, whether it's Asia or where opportunity lies, if it's with founders that actually feel have good alignment with, what we can add value to. And my background is from a founder operator experience, started very early in startups. And one of my companies that I founded had a acquisition. So from there, that's when I started to decide to give back to other founders and startups and hope to, invest in them, advise them, and help them amplify and accelerate their, progress. So, very, honored to speak with everyone here. Some thesis that I believe in and have been investing in is fintech, obviously enterprise, largely enterprise. Consumer is great, but I think more of what my team understands and can bring value is enterprise. Recently, very fortunate, had a few exits. So even though we invest in early stage, those do take a long time because of the growth of the company. And some companies that I invested early when I came to Silicon Valley, spent some time at Stanford between 2011 to 2013. To get mentored from great VCs and build out my ecosystem of network. Investing early at that time was, great. By now, there's a company in construction tech that exited, a company in biotech, and then a company that is in essentially VR tech. VR tech largely is because of COVID-19. So very interesting to see the changes in kind of market valuation, and then obviously the changes in terms of fundraising, and trying to always think from the founder side and kind of guiding my portfolio company and new companies that I hope that I can help with. Recently, obviously one of the top portfolio companies in my portfolio is a regulation tech authentication company. The team is an expert in fintech payment, so it was very natural for them to see the need with privacy, which obviously is related to GDPR. And then recently in California, January the 1st, CCPA. So I care a lot about privacy and data usage, and what us as users, consumers, should believe in, and what our rights are. AI obviously is something interesting. I do invest in that, but that obviously has allowed for technology to, essentially be able to capture a lot of data. So that's why I believe that, while investing in AI, it's also important to be responsible and invest on the other side. So, Elena, thank you. And the rest of the panel, love to see how I can contribute today.
Thank you. Thank you. So how many portfolio companies do you have, and did they change the company strategy because of the current crisis? So this is the question to Tess and to everybody.
Great. So thank you. So I myself have been investing very early. So through my own personal investments and also some of my other entities, sometimes I invest through special purpose vehicle, but largely now through, combined with Tess Venture, I would say I have over 50 companies. Some in the last few years, definitely I believe in frontier technology. So some of them are in blockchain. And, I think the magic and like the sweet spot is founders that have built real companies that are from the kind of the traditional world, that understand that blockchain technology can actually be very important to many sectors. So the market needs to go through these market cycles, and also regulatory and regulation need to be established before critical mass adoption. So I believe in patience, and I think eventually sticking to some of the thesis you believe in is very important. And in terms of fundraising, startups and portfolios, that are in my portfolio, and also in a lot of my VC friends, the focus of VC truly, when COVID really hit, was to focus on helping their own portfolio. However, I would say if it was a company, what I saw was related to COVID-19, health, anything that involves in this new work tech, this remote tech, was actually still very desirable, and there are a lot of investors investing in it. Largely, even investors that didn't invest in health, that didn't really understand, vaccine biotech, that actually probably never invested in this area started to put money in. So obviously that drove up the demand. However, on the other side, obviously everything that we thought was very exciting became challenging. Anything that was collaborative, everything that was sharing related. And I think, there are some obviously clear companies and sectors that became very, very, desirable. And even companies that you guys obviously have noticed would pivot into these themes. So, that's one of the first things. The second thing is clearly it is a lot harder to fundraise because we are all working remotely. So that's why it's even more important that you bring on really good strategic investor, or utilize and work closer with your existing investors and existing advisors, or advisors that you think can help you in this next journey, which is in this new normal economy, which is very different. I myself have seen one of my companies that I invest and advise. Limpo, they originally were a health technology that was able to capture a lot of data and help everyone with wellness and focus on just making sure you exercise daily. What they have seen very quickly, and this is a European company, but they're based in Europe, but global. What they have seen is very quickly their technology and their capability was able to help COVID related initiatives. So they actually became very needed in their country. And the team also has partnership with Korean about pharmas. So they, I think today it actually, many teams, no matter where they're sitting in, wherever city, is either distributed and also focusing on a very global market because of technology has enabled us to do that. So maybe I'll pause there and definitely love to hear what the other panelists would love to share.
Thank you.
If you don't mind, let me add to something that I said earlier, just very quickly.
Of course.
So,
Of course.
my thesis was that depending on your model, if you have a light, fast adoption model, you might survive better, unless, of course, your industry is completely hit. One company example I want to give this is about innovation. And it's a company called Happy Signals. We have not invested in it, but we happen to know them. And they sell this employee experience management software in the ServiceNow ecosystem mainly. But anyways, for measuring how employees fare with IT. And it's a fairly heavy sales process and a fairly long one. So when COVID hit and everybody went remote, they innovated really quickly. So they released a free remote working employee experience management module, which actually got a huge uptake. And although it was free, it resulted in really good business for them because it's got them new customers who used it for free, who then actually became commercial customers for their heavier general solution. So with your quick, even small innovations might really make a difference. I also hear the noise, by the way. I really hope it's not from me.
Yeah, maybe the person that's not speaking can be on mute. I just to answer the question very quickly, we have over 40 portfolio companies that are active right now across both of our firms, Grisham Robotics and Strive Capital. And I normally classify what's happening in the market into really three camps. So cyclical companies versus counter-cyclical companies. Counter-cyclical companies are not getting super affected because they're in markets that are not affected by what's happening with COVID right now. Cyclical are, and then we have obviously positively affected and negatively affected by what's happening in the market right now. We've been very lucky. We've only have two companies that I'm involved in that have been negatively affected. Significantly negatively affected. One is in the travel space, the other one is in the HR, talent acquisition, recruiting space. We've also been lucky that we have actually a very significant consumer portfolio, and a lot of our consumer portfolio is doing incredibly well. We've had one IPO, which was a reverse merger into an IPO, which is DraftKings, that obviously IPO'd just before the COVID crisis really started becoming big in the US, and has gone very, very well. The stock price has gone through the roof, as everyone knows. So it's been a little bit of a mixed bag. I think right now, someone was making this point earlier. I believe is potentially Chris. There is sort of this notion from a venture capital perspective of lack of clarity in terms of markets, and you really can't bet on a bad market, right? So you can have the best team in the world. If the market is bad, likely the company's not going to succeed. So at this stage, the biggest issue is we need to figure out which markets are going to rebound and how. But we also need to figure out the markets that are going through the roof right now. For example, gaming, collaboration, anything related to remote working, which is going through the roof right now. We also need to figure out if those markets are at peak level right now and they will sustain that level afterwards or not. And I think that's the biggest challenge right now in looking at portfolio and helping portfolio, is also to help them figure out markets and figure out how to do small pivots or small alignments, small changes in go-to-market, changes in team, and in some cases make the tough decisions, right? In the case of our two companies that are not doing so well, having that discussion on what's your cut to the bone scenario. What would it look like for you to actually be in survival mode and live to fight another day? Now, no investor wants to have that discussion with their portfolio companies, but you do need to have that discussion, and you need to have it pretty early on into the cycle. Certainly, hopefully, when things started in late February, in March in the US, and probably earlier even in other parts of the world.
Great, thank you. Okay. Omiros, do you want to tell us?
Yeah, I'm glad to.
Thank you.
Alexey, I think it's his frame froze. Look, we are a bit different because this is enterprise technologies, infrastructure, big data, SAAS, and security, and we're invested in all of them. And we actually had a very similar session here from my former business school. And there were about 70 people that came in. We all discussed how we innovate through the crisis. And it's exactly what we're discussing here, right? There are three things that happen. One is you defend the fort, so you provide liquidity. The second thing is that you're trying to pivot through innovation. So, for example, I have an nanotech business in Greece, which exports maritime applications for ships around the world. So once you have dry dogs being frozen in China, you can no longer paint the ships, right? But you can pivot to go into sanitizers using nanotechnology. We have robotics companies that went into a different space. They use the R&D time to come into products, into robot as a service. There's a lot of things you can do. Obviously, the software companies are affected less because people are used to remote working. But I think that the crisis, good crisis go away. Crisis is an amazing opportunity to actually both invest, find good companies at attractive valuations, whereas before they would be riding a wave of extraordinary growth on the back of the market. Second, you can look at the good managers. You can see who has acted, who has gone into the right insurance policies, who's managing cash, who was getting a free ride, and who's actually very competent. So I think that the crisis is a fantastic opportunity to separate the wheat from the chaff. And there was a lot of funds which have been built during the crisis. We had applicants from some of the largest funds in the world, which are dropping out and they are forming their own venture funds, or they want to partner with other fund managers, because now it's a very good vintage year. The vintage years that you're going out during and after the crisis are the best years to invest. Whereas before you were riding a bubble and probably most people investing over sensitive valuations, right? But I think COVID is a very good opportunity for quality investments. It's a very good opportunity for fundraising, for vintages, and a fantastic opportunity to really test your captains of your ships, how well they can steer those boats.
Yeah, I totally agree with you, Omiros. And I see that there is a lot of opportunity for the founders, because after a massive layoff, a lot of engineers and managers become available for hiring for a reasonable price, and it's good for hiring to have enough revenue and money. And for investors, it's a good time to invest, because a lot of founders, as you said, shows how good they are in management and execution. Because first that we asked in the end of February, I think, we asked all portfolio companies to reshape the budget and make it as long as you can, lasting for at least 12 or 18 months. And then we helped them with a PPP loan, which was a very supportive initiative of US government, and it was really helpful for many of the companies. And it's a good time for negotiation, because our sweet spot is a post-seed company. When the company had funding from seed, and it's after 6, 8, or 10 months after previous funding, and we can make a bridge into a new company to Series A, and the terms are pretty nice, and we like it. And another thing for a software company that brings amazing opportunity is that I see the crisis unveil a lot of sales opportunity in terms of old school industry, because now we see a really big trial of software for very conservative users and decision makers in old school companies, and it's a good time for sales.
Thank you very much.
I think we kind of covered some of that, and that cash runway is, definitely, everybody's kind of looking to extend the runway, look carefully at ad budgets, figure out what's working, double down on what's working. Don't necessarily assume that what worked pre-COVID is what's working for you now, that kind of thing. But it's all about runway right now.
Yeah, and I mean, on that note, we like our companies to try to have at least 18 months on runway right now. And it comes mainly from the fact that it's really hard to plan when you don't know yet completely the impact, because it hasn't been going on for that long, and we don't know how long it will last with what impact. So we try to get them to have an unusually long buffer before they need to either raise more funding or just in general, come hopefully to break even or such, to feel really safe. It's a very difficult time when it's hard to guess the next 3 months, not to mention longer periods.
Well, there's also the element what kind of a seed you are, right? I mean, before it was mentioned by Nuno, I believe, about the ability of LPs to invest. So we're FCA regulated, the equivalent of SEC in America. Over a particular size, you cannot be not regulated in Europe. And we run administrator, our securities managing about $500 billion. And when you're getting money from your LPs, they have to be able to put it up at any time and upfront. And when you sign a deal with your portfolio, you're supposed to represent also that strong financing platform. So one of the things that you want to do is test your relationship with your portfolio at the time of the crisis. If you go up there and start negotiating runways and don't appear as a partner, or you squeeze them out of the term sheet, maybe that's once things return back to normal, maybe you are flagged as as a hawk who is trying to look for a bit more equity at the peak of the crisis. I think the number one thing we should do, right, is like a father to a son or to a daughter, is to protect, nurture, and develop. Make sure that these people can actually do their job without having to go to nightmares at night if they will survive the next day. Make sure that these people can actually perform and innovate and be able to vision again a way out of this tunnel, rather than counting every day their payments. And I think it's very important for us to have the responsibility to provide that level of comfort to our companies and to any partnership, because partnerships are tested in difficult times, in testing moments, rather than when you're riding a market. It is now that you're proving yourself if you're a partner or just some money that betted a few $1,000s. I mean, we bet a few million rather than thousands. But I think now it's an opportunity for us to prove our worth in this market, not just financial contribution, but strategic partnership and a strong foundation.
Thank you. Shall we move to the next question about corporate VC and financial VC? What COVID has surfaced having them in startups cap table?
What I've observed until now, there's been a step back certainly from a few corporates that were very aggressively investing. And it's normal because a lot of corporations are going through their own complexities, large corporations, so they need to re-equate how they deploy capital. And a lot of these are actually deploying capital directly from their balance sheet instead of a fund. I would say this might be actually a really good time if you're a corporate to buy companies. And so if I was in their position, and I've been in their position, I used to head strategy, corporate and business development for a few corporates over my life and my career. I would basically be looking for good assets that I could buy out at this stage. And we've seen Uber being very aggressive in consolidating a couple of markets. And we've seen a couple of other tech companies that have really been aggressive going into the market. I do think this will change. Again, it's an item and an issue of clarity and cash flow pressure at this stage. I do think a lot of these corporates will come back to the market. But if I was in the position of a lot of these corporates, I'd be certainly amping up my corporate development M&A focus.
Yeah, I agree with that. I also have a CVC background many years ago. And I took a quick look at some data on this because I was curious.
Anyone else
actually,
has an opinion on this subject? Thank you very much, Nuno. Corporate versus financial.
Chris was speaking. Yeah, I think so.
Oh, sorry.
Go ahead, Chris.
No, I was just going to say, I was able to find, so this is a US number, but Q1 this year was 13% down from Q4 of 19, which is remarkably little compared to, a lot of the VC deployment is down in the 30 or 40%. So actually CVCs seem to have reacted a little slower than I would have expected. But I do expect they will cut back for the question that Nuno just mentioned. These guys often are having to apply for budget, or, these larger companies are also sometimes suffering in certain areas. And those who are suffering, this is a very tempting place to take budget. Usually cut ad spend first, and then you can kind of cut some of these programs. But I do agree, this is a great time for them to actually be out and active in the market. I would expect that a lot of the serious CVCs would be looking at a little bigger deals because the valuations have come down so much in certain areas. Certainly not in the public markets, but in the private markets, I think they could be looking to make maybe more significant acquisitions rather than the earlier stage stuff at this point, because right now they're going to have a little harder time to justify each kind of investment.
I don't know, guys, I can give you perhaps a glimpse of ray of hope because in our market things are booming. And I can give you some data which are relevant to you. So when you, by the way, Chris, you say CVC, I'm thinking of the CVC Capital Partners, which is a fund of 75 billion. So
nothing to do with Citibank.
Not Citibank, CVC Capital. With regards now to the corporate ventures, I mean, in our market where we invest, and I said before, we invest in growth capital in Greece, right? So in the last 4 weeks, Microsoft bought a robotics company called Softomotive. You can Google it. Think Silicon, was sold a few weeks ago. It was 1 year holding from the private equity fund that holding. It's actually people that we know, they are called Metavalon in Greece, a small fund that is doing phenomenally well in that market. Actually, out of the same fund, we're about to experience also another deal, which is oversubscribed, which I try to go into collaboration. And I know they are oversubscribed right now. It's a deal relating to logistics. And we know already there was a Graphene Capital in London, or whatever they're called, Graphene, They invested in Omilia, which is an AI, 20 million Omilia, which is AI voice to text. So that is in the last 4 weeks, right? Particularly the Microsoft deal. I was rather impressed because the CEO came in and talked about it as part of his overall speech, right? And that was in a tiny market in Greece. In the same country, you also have Elon Musk, who opened up an R&D facility inside the university called Democritus, the Tesla facility of R&D there. So I think there is a very big gloom and doom for certain industries, but people who are visionaries will see this as a phenomenally good point to buy cheaply, because people who are growing exponentially, they will actually demand very high prices back in February and January. And I think now it's a good time to invest, and also it's a good time to capture opportunities in even cyclical companies that will experience that deep dive, but then they will come out much stronger, much leaner, and much meaner. So there is certainly a glimpse of hope there. That's why we can see a lot of vintages from very big funds which have come up. I don't want to advertise them, but there's over the last 6 weeks, for people who have access to the major databases, you can see the vintages that have come up are phenomenal. And across all lines, VC, credit, debt, everything in between. And we will see obviously a lot of NPLs, but that's a different story, which is outside of us altogether. But I think that people who know what they are doing, this is a good time to buy. M&A should be boosting by the end of next year.
Great. So we have another question. Do you have any successful pivots with your current portfolio companies? Chris, do you want to take this question?
Sure. We have a couple that are suffering pretty hard. We have one company that lets out film equipment, for example, like video equipment in New York City. It's called Kit Split, and basically film production in the U.S. has been shut down for a couple of months. So they've basically gone into cash conservation mode, full stop. The one successful pivot that we had a social ticketing platform called Get, and it's essentially, think about like an Eventbrite type of platform, but it's more for clubs and university groups and more informal type of events. The in-person stuff obviously was shut down in most of the world, but they were able to change to a kind of virtual meeting type platform. They were pretty proactive, got out a survival guide that they sent out to their customers, and actually had a pretty decent conversion rate of getting these people to continue their subscriptions and to do social ticketing on kind of Zoom type events. Otherwise, actually, pretty much we've got about 35 companies in the portfolio. Those are the only two that are dramatically affected by COVID. So that's it.
I'm really sorry, I have to go to another call. Thank you, everyone, and have a great day.
Thank you. Thank you. Bye.
Thank you.
Okay. Do we have any other stories of successful pivots in nowadays from you guys?
I mean, small pivots, right? Changes around go-to-market, changes around marketing and sales, more aggressive inside sales, really stopping all the elephant hunting, as I call it. So all the, field sales piece. As I said, most of my companies, I have a very significant portfolio in consumer, so those companies are doing necessarily pretty well. The only thing I would add in terms, it's not so much again a pivot because there's no business model change or shift, but more from an operating model perspective, is obviously the remote working conundrum. We've always been very positive towards distributed teams. I wouldn't say fully liquid, but certainly distributed. And with what's happening, we've seen a couple of our portfolio companies that were a little bit more centralized in the Bay Area or in other parts of the world. One that comes to mind was in Europe, in Southern Europe, really becoming much more distributed by nature. Actually, by virtue that their employees were stuck in different places in the world. And so they started working distributed, and now that's shifted the culture of the company significantly. Again, no significant pivots on business model.
For us, actually,
Great.
has been transformational.
Sure. And we supposed to, yeah, of course, go ahead.
Sorry. So for us, we have, the pivoting was actually phenomenal. We had to change completely the course of the direction of some of the companies for a few months. So we have an nanotech company which serves the construction, maritime, and photovoltaic industry. And during the period of the crisis, they also innovated internally. They created a whole new business unit within 3 months with one of our portfolio directors. And they are now going, actually this month, into the cleaning industry, in sanitizers using nanoparticles. So for them to start from the beginning to the end, new products, new labels, new designs, new production units, CMOs, own production, all of these things all happen within a matter of about 12 weeks, which was phenomenal. And we have very big expectations from that unit. Another company that we have in software, so that's a company called Nanofos. Another company that we have in software called Terracom, and they are one of their star products is a product called Cure Patrol, which they are guard management. The same software can also be used to facilitate access to doctors and to monitor them, or doctors, nurses, people who have who are susceptible to COVID, and geolocations together with hardware and software with beacons. So they actually work with us to have an offer, a global offer, to give their software for free to all hospitals or healthcare workers worldwide. And in fact, it was an offer that we promoted to Financial Times, Bloomberg, to I think it was read by 150 million people from the promo materials that I got back then. It was up on 165 websites, which in theory covered 150 million people. And the last but not least, a robotics company, a company called GR Robotics, which they were doing solutions custom-made. They took the downtime to create 11 ready-made solutions. They actually took the finances of the bank and they innovated into going robot as a service. So they could go to customers and say, you understand it's a COVID period, it's hard to buy, but you can lease this from us. And also they went into the sanitizing business. So they started innovating with us, having a combination of software and hardware to look into sanitizing solutions for hospitals and for manufacturing. So the opportunity for us, it was very deep pivoting, I have to say, and it was a good opportunity to see how the managers were reacting, how the production and R&D was reacting, and the most important thing to see how important is the intellectual property and innovation, not just organic sales, but trying to create value through other means, IP, patents, R&D. I mean, and of course, during this crisis, we even submitted a new patent during this period. So for us, it was an opportunity to put everything to the test.
Great. Okay. So should we start the pitching session right now?
Yes, yes. Let's do the pitching session. And so the pitching session will be as follows. The first project will present for 3 minutes, then investors will ask questions for 3 minutes, and then we move to the